What is the difference between an outright forward contract and an NDF? Hello, everybody. I'm a learning partner, Sushila Hariharan. And if you are interested in a career in investment banking, trade life cycle, financial markets, OTC derivatives, as well as hedge funds, do subscribe to my YouTube channel where we provide content centric research focused videos on these topics. So let's first understand what is a forward contract. A forward contract is a contract which is entered into between two counterparties to lock in the price of the underlying asset, but the delivery of that asset and the full payment of that asset is going to be done at the contracted price on a future date. So over here we find that the forward contract vis-a-vis the spot markets are basically looking to reduce the risk associated with market price fluctuations. In common terms, this is called as market risk. So the contractor who wants to lock in the price for the asset for some time in the settlement in the future, let's take a look at example of the usual rice farmer example, is sowing the crop today, and after 3 months they will be in a position to harvest the rice crop, right? But the farmer for these 3 months is exposed to price fluctuations of rice. So when he is investing all the money associated with seeds and fertilizers and pesticides and water and nurturing the soil, he is unable to find out what is the price at which he is going to get for that rice. To help this kind of producers, to help these kind of individuals or corporates who have exposure to price risk, we have forward contracts. So the rice farmer would like to sell a forward contract for the rice produce, which is going to be delivered or sold by him to the wholesaler, but 90 days in the future. At this way, they find that the price at which they're going to get for a product that they will harvest 90 days in the future is locked in. This gives a comfort to the rice farmer that his costs will be recovered through this mechanism. So a forward contract is nothing but a contract to lock in the price for the asset, okay, but the settlement of which is going to take place at a future date. Now, forward contracts are typically OTC derivatives. So why are they called derivatives? Because the contract is derived from the price of the underlying asset. So how does the rice farmer determine the price of rice that he is going to sell 90 days hence? He will look at what is the price of the rice right now. Oh my God, that's sounding so, mouthful, rice and price. So he's going to lock in the price of the rice which is going to be delivered 90 days hence, right? So the underlying contract is spot rice, whereas the forward contract is for the price of rice that is expected in the future. Next time I should take another example other than rice. Okay, the forward contract thus eliminates price risk, as we would like to call it. So these are derivative contracts. Why are they OTC? They are OTC because they are not done through an exchange. If they were done through an exchange, it will be called as futures contracts. But forward contracts are OTC, which means these are bilateral trades between the buyer and the seller. Mostly there would be a dealer who's acting as an intermediary between the buyer and the seller, and the dealer gets his commission for initiating the trade. So suppose the price of the contract is, let's say, $100, and the delivery of that asset is 90 days in the future. Then the forward contract, the buyer of the forward contract says that he is going to buy the underlying asset at $100 90 days hence. The seller of the contract is going to say that they are delivering the asset for a price of $100 90 days hence. All right, so there's a price lock-in. Both counterparties pay up a small little margin in order to be able to initiate the trade, so it brings a commitment to the trade. Most forward contracts will also be accompanied by a ISDA agreement, that is the International Swap and Derivative Association agreement, with all its clauses. Okay, so this is a case of an outright forward contract. In an outright forward contract, On the settlement date, the buyer pays $100 to the seller, and the seller gives the asset to the buyer at $100 irrespective of what is the price of the asset prevailing in the market on the 90th day. Okay, so the main objective of an outright forward contract is that the asset price is locked in, thus eliminating market risk for both the counterparties. On the other hand, in the case of a non-deliverable forward, NDF, an NDF contract is when the buyer has bought the the asset for $100 on the 90th day settlement. The seller has agreed to sell the underlying asset at $100 for delivery 90th day. On the 90th day, the price of the underlying asset is $90. Okay? So on the delivery day, the price of the underlying asset in the spot market at that point of time is $90. So the buyer has actually agreed under the forward contract to buy at $100, all right, and the market price is $90. The seller has agreed to sell at $100, but the market price is $90. So over here, the buyer and seller just make a cash settlement. A cash settlement is when the loser pays the gainer. Over here, we find who is the loser? The buyer, who has to buy at $100, or he can buy at $90 in the market, or is it the seller who has sold at $100? Why would you want to sell at $90, right? So the gainer is the seller, the loser is the buyer pays the loser, the gainer pays the receipts from the loser, this $10 difference. Okay, so over here we find that in an NDF, non-deliverable forward contract, the loser pays the gainer the gains. There is no exchange of cash for asset on the delivery date. Is this clear? So in an outright forward, the market price on the spot date, on the delivery date, is immaterial because the contract is exchanged, the security is exchanged for cash at the contracted rate on the settlement date. On the other hand, in the case of an NDF, the loser who has lost money will pay the gainer the difference between the contracted price and the prevailing spot price, and there is no flow of security for cash in a NDF. So cash settlement is an NDF, outright settlement is a outright forward contract. So cash settlement, NDF, physical settlement, outright forward contract. So NDFs have become very popular for currencies which are closed currencies like USD, KRW, that's the Korean won, heavily traded in markets other than Korea. Okay, because then you are only paying the difference between the contracted price and the prevailing spot price on the settlement date and settling it in USD. And as you know, USD is well accepted currency in most markets in the world. So NDF in currencies like KRW, INR, USD, INR are very, very popular amongst foreign exchange focused hedge funds, FX trading hedge funds, especially for currencies that are rare to get otherwise in the global markets. So just remember these 2 points. In outright forward, there is physical settlement. In NDF, there is cash settlement. There is no exchange of securities for cash in the case of an NDF. In the case of an outright, there will be an exchange of securities for cash, currency for currency on the settlement date. Thank you so much for listening in.